and gentlemen, good day and welcome to Cromption Greaves Consumer Electricals Limited 1Q FY23 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Renu Baid from IIFL Securities. Thank you, and over to you, ma'am.
Thank you, Aman. A very good morning, everyone. On behalf of IIFL Securities, I would like to welcome the management of Crompton Consumer for the 1Q FY23 earnings conference call. Today, from the management, we have with us Mr. Shantanu Khoshla, Managing Director, Mr. Matthew Job, Executive Director and CEO, and Mr. Yashwant Rege, Vice President, Strategy and Financial Planning. Without taking much time, I'll now hand over the call to Shantanu for his opening comments. This also is the first quarter where the entire results of Butterfly are consolidated with the financials of Crompton. So over to you, Shantanu. Thank you.
Thank you, Renu, and thank you everyone for dialing in for our quarter call. Firstly, of course, on health and safety, all our employees are safe and sound, I am pleased to report. We have essentially vaccinated all our employees and have initiated booster camps at all our plants and offices. We have conducted supporting sessions focusing on mental health and well-being with the aim of cultivating a positive work environment. So our focus on first and foremost making sure in the challenging times that our employees and their families, plus our other stakeholders, stay safe and healthy continues. Our consolidated revenue for the quarter was 1863 crores, registering a growth of 77% year-on-year. EBITDA on a consolidated basis grew 76% at 220 crores. Standalone revenue for the quarter was 1608 crores, registering a growth of 54 crores. EBITDA was 194 crores, which was a growth of 58% year-on-year. Of course, it's important to note, as you are all aware, that the previous year base period was a COVID period and therefore was a low base period. Today, I'd like to start with updating you briefly on the Butterfly acquisition. In the last quarter, we completed the open offer process for the acquisition of 26% stake, taking our total shareholding to 81%. The tendering period for the open offer commenced on 23rd May and concluded on 3rd of June. The new management has fully taken over and the business is transitioning smoothly. Synergies identified as part of the integration plan are under implementation and obviously something which we review regularly through our PMO, and the initial results are encouraging. Going forward, the focus would be to further expand the business into non-South markets, as it will be a key value creator for which we plan to initiate the work as we move forward. The overall performance of Butterfly was encouraging in the first quarter and quite strong. As communicated by the Butterfly management, Q1 witnessed strong growth across all categories and channels, as well as a rebound in profitability. Business clocked a value of 253 crores, which was a growth of 86% versus a year ago, recording all-time high sales for the first quarter. EBITDA stood at 26 crores, which grew 3.5 times, and EBITDA margin was 10.2% versus 5.3% versus a year ago. The management believes that the growth in revenue and margins is being witnessed on lines that we had forecast and expected, and we do see this level of margin as a going level which is sustainable. The second key event over the quarter was obviously the entry of Crompton into an entirely new segment. Working towards our long-term strategic goal, we entered the built-in kitchen appliances segment with a comprehensive range of chimneys, hobs, built-in ovens, built-in microwaves, and dishwashers. The kitchen segment has always been an area of focus for the company. The entry into the built-in appliance segment will further consolidate our position in the kitchen space, in addition to driving growth and premiumization of the brand. We undertook extensive consumer research to identify unmet and underserved requirements of the consumer, and that was the starting point of the design of all our propositions. Based on these insights, we believe we are launching a truly differentiated product range which will be of high relevance to the consumer. We've already set up 17 premium exclusive brand outlets called Crompton Signature Studios till date and have a robust marketing plan and have established a strong after-sales network to ensure end-to-end superior experience for the buyer. Built-in kitchen segment is 2,200 crores approximately, which is growing at 10%. Our objective is to become a top 3 player in this segment in the coming 3 years. With the acquisition of Butterfly Gandhimati appliances and entry into this built-in segment, we are significantly upping our play in the strategically important and high potential kitchen space. Moving on to the Ctcl business. In terms of revenue, the growth momentum of March 22 continued in Q1 with strong growth across segments and channels. Revenue for the quarter was up 54% versus last year. ECD grew 52%. Net of pumps, ECD grew 60%. Our pumps business continues to face some challenges, especially given the pricing that we have been taking to compensate for the inflation. Appliances exhibited industry-leading growth of 98%. The growth momentum across categories, especially on air coolers. If you recall, this is the first summer we had after two summers being wiped out due to COVID. And we have now put in our delayed program on air coolers into the market, similar to what we had done on geysers a few years ago. And in this first season, it has responded extremely strongly, with air coolers demonstrating a volume growth of 209% and a value growth of 218%. Lighting revenue grew by 61%. The growth momentum continues in B2C LED business, which grew at 82%, driven by battens and panels. On battens, the volume growth was 19% and the volume growth 80%. Panels and downlighters, volume grew 64% and value at 96%. B2B business grew by 48% as the business is gradually recovering and picking up. On a rolling 12-month basis, we continue to improve our market share and have improved in fans by 2 percentage points. Over the last 2 years, Crompton is the only company to have gained market share quarter on quarter, both in premium category and overall fans category. Just to repeat and remind everyone, when we report market share based on third-party retail audit data. Moving on to profitability. After an unprecedented increase in Q4, the commodity prices started cooling off from the latter half of May. However, we expect the main benefit of this to begin to flow in Q2 due to the existing inventory levels which were already with commodities purchased at higher prices. We have been focusing our efforts, as we always have, on quarter in improving margins through accelerated cost savings through our Nati program, premium on demand. The government's capex push will be a positive for the infrastructure and construction goods sector going ahead. Healthy growth in bank credit and improvement in capacity utilization levels also point towards gradual improvement in the overall investment scenario. As we move forward and as we see commodities begin to gradually ease, if they do that on a sustained basis, we will continue to evaluate and pass on benefits of this commodity cost reduction to the consumer to ensure that demand recovers and stays robust. Now, quickly taking you through the numbers. The Board of Directors in its meeting held on 22nd May 2022 approved the quarterly results of the company for the quarter ending 30th June 22. Total revenue for the quarter was 1608, consolidated 1863 crores. ECD revenue stood at 1347 crores. Material margins stood at 30.7%, consolidated 31.4%. I would like to stop here and address any questions that you may have. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Naval from Emkay Global. Please go ahead.
Yeah, thank you for the opportunity. I have a first question on built-in kitchen appliances. So, if you can share some, target addressable market, if I would have missed in your opening remarks. And second, in terms of distribution, if you can explain how distribution of or sales happen for competition in this segment through EBOs, through online and through offline, and what is our strategy in terms of in next 2 to 3 years, how distribution could be different. So basically, I'm trying to understand what is the right to win for Crompton over here in terms of product distribution and other aspects.
Okay, let me take the first one, and I had mentioned it in my open remarks. Currently, the market size for chimneys and hobs is 2,200 crores. That's only for chimneys and hobs. This market is growing at 10%, and our objective is to get to at least the number 3 position in this market within 3 years. On your second question, let me take one part first, and then we'll get to the distribution. The key differentiating factor, and that what we call our right to win, is based on meaningful consumer differentiation. So every one of our products have a meaningful consumer benefit which competition does not offer. So they are not off-the-shelf products. They have been designed based on work we've done in the consumer and in our R&D center and designed on those specs. For example, just to give you an example, and this covers across all products. If we look at our built-in oven has got an air curtain in the front. So when you open the door and there is something hot and steaming, the steam doesn't come out and burn your hands. It is protected and held inside. Our stoves, for example, our stoves have a specific feature which is an automatic cutoff for safety. So these differentiations have all been tested to be consumer meaningful. In concept tests, they test significantly better than like-to-like competition, and they have been designed into each and every one of our offerings. So that's right to win, number 1. On the go-to-market, I'll just let Matthew take that.
Yeah, on go-to-market, obviously, there is going to be a variety of channels. Obviously, the EBOs are experience centers where we are able to showcase our full range of products. That's obviously in each of the top 10 cities, that's going to be a critical part. But we also have, for example, other channels. One is the kitchen dealers. Then there is retail chains and online, and we have a clear strategy for all these different channel types. So we expect that all these channel types, the four that I mentioned, EBOs, kitchen dealers, which also then MBOs, which is multi-brand outlets, and e-com, all will play a significant role as we scale up. And we have a differentiated strategy for each of these channels, which will allow us to reach our ambition of getting to the top 3 in the next 3 years. It's a combination, Shantanu mentioned, the combination that every one of our products offers a significant, consumer relevant, differentiation versus the competition, and the fact that we have worked out a strong channel plan. We are very confident that the combination of these, along with marketing campaigns and so on and so forth, will help us get to the top 3 position in the next 3 years.
Sure. And follow up on this is for industry, if you can share the channel distribution, how it happens right now in terms of,
I'm sorry, but just a request, just to give everyone a chance, you'll move on. If you have further questions, either we can cover them at the end if you have time, or please feel free to contact us after the call, and we're happy to share whatever we can. Can you work it? Yeah.
Sure, thank you.
Yeah.
The next question is from the line of Rahul Gajre from Haitong Securities. Please go ahead.
Yeah, hi. Thanks for the elaborate opening remark, covering most of the areas, including value, volume growth. I've got 2 questions. One, we've seen a sharp jump in the employee cost. So that is the first. I just want to understand what has really gone in over there. And second thing is, with respect to the new built-in kitchen appliances, given our traditional business has a margin of in the range of 13-14%, what is your expectation on profitability of this new business? So these are the 2 questions. Thank you.
Okay. Let me address them. The first one is there are certain if you will, one-time, non-recurring expenses which have come this quarter in the people cost. One of the costs is based on the fact that our variable payout is decided by the board based on our performance versus competition. This tends to be done obviously after competition results come out, and therefore in the end of June sometime. So there was a certain amount of we had provided less than what the board actually provided, so that is a one-time cost which has come in. The second thing on people cost you just need to remember is in the COVID period, and last year was the COVID period, we had delayed our increments and we gave increments in July. This year we went back obviously to our norm of giving them in April. So if you want to look at a steady state, what it would be for the rest of the year, a number of somewhere between 100 and 105 crores would be the run rate which we would be operating on. The second question which you had was margins, our expectations on margins on the new appliances business. We would expect gross margins to be in line with our other businesses, and obviously in
in terms of it could be in terms of pricing, but also in terms of introduction of some newer SKUs to be able to manage the price pressure in the market. So a combination of those actions we feel that will allow us to get back on the growth path in pumps in the next few quarters. That's one. In lighting, B2B trade business has started to pick up. In the earlier years, we used to have significant contribution of ESL. We do not expect that to come back. Our way forward in terms of the lighting growth is one, obviously, to get disproportionate growth from B2C. We have been taking a lot of actions in terms of driving our or slightly modifying our lighting go-to-market. And we are happy to actually say that in the last 2 quarters, maybe our reach numbers have started to look up again. That was not the case for almost 2 years before that. So we see that in the short term, in the next couple of quarters, that will start translating to market share gain also on lighting. In terms of margins, I think the lighting structural margins are fairly intact. In Q1, you would have seen the lighting EBIT itself has come down a little bit because of stepped up advertisement. We nearly spent 1 percentage point incrementally on advertising in the first quarter, and there have been some provisions in terms of ECL provisions, primarily because of some slowdown in payment from ESL and so on and so forth. So I'm very confident that in terms of lighting structural margins, they're pretty much intact. Obviously, like I spoke for pumps, there's also in lighting the GST rates have been increased from 12% to 18%. So there is some new element which we have to manage. But going forward, I think B2C is going to be the growth engine at least for the next few quarters. Thereafter, we expect the B2B demand also to revive. Based on also what Shantanu mentioned in terms of government infrastructure and capex investments in highways and so on and so forth. But we think that at least in the near term, lighting growth will be driven by B2C, and there our margins are pretty strong.
So thanks for those detailed answers. That's all from my side. Thank you.
Thank you. The next question is from the line of Mayur Patel from IIFL AMC. Right?
Hi, thanks for the opportunity. Most of the questions have been answered, but just is it fair to assume margin outlook from here looks relatively more benign given the 20-25% correction in most of the commodities which we have seen? And also after that, if you can comment on the volume side, till date for the industry, the price hikes have been driving the revenue growth despite flattish to negative volumes in most of the categories. What is the volume trajectory looking like currently, and how do you see that panning out with some commodity correction? Is it more elastic on volumes? Thanks.
Even if I look within the quarter, within quarter Q1, the margins have improved. In fact, in March, where we were in March and where we have been in June, I think the structural margins have improved month on month. So obviously, some of the benefits of commodities starting to ease off have started to come in maybe towards the later part of the quarter. Of course, now we are making certain assumptions in terms of how the commodity costs will fare going forward. And the commodity costs do remain benign. Obviously, we think that part of we also have to pass part of that to the consumer. But we do believe that in such a case, the pressure on margins that have been there for some time should start to ease, going forward. Yeah. What was the second question? One more question. What volume cost? Yeah. See, even in the quarter, if I look at the businesses that we have, barring pumps, okay, all the other businesses have had, even on a 3-year CAGR basis. I'm not comparing with last year because last year was a COVID hit quarter. For example, fans. If I look at the 3-year CAGR of roughly 10%, half of which is volume. So I think volume growth is there in fans. Most of the growth in both lighting and appliances have been volume led. So the volume growth is extremely strong both on lighting and appliances. The only area where I feel the volume growth has been impacted is on pumps, and I already answered what we are planning to do to get that back on track.
Sure. Thank you. All the best.
Thank you. The next question is from the line of Siddharth Bera from Nomura. Please go ahead.
Thanks, sir. So my first question on the new category of kitchen appliances again, which we have recently entered. Can you just highlight in terms of ramp up, probably city-wise, which regions probably you will look to ramp up, and how gradual should we expect it to be? Will it be more back-ended, or we will start seeing sort of some benefits coming from next 1-2 quarters only? And second will be on the market share, if you can highlight in terms of where we are currently in terms of fans, air coolers, and geysers.
Yeah, on the new kitchen, built-in kitchen segment, we have currently the plan is within the next couple of months to completely roll out into 10 city clusters, which is primarily all the key metros and areas around that. Our estimate of the potential is 60% of the potential of the market, which is 2,200 crores, 60% is actually in these 10 city clusters. That, we have already done 7 out of this 10 already in terms of getting into those areas. But the plan in year one, which is, we just launched starting May. So by May, June next year, we will have a presence in the top 300 cities in the country, which will pretty much, cover more than 90% of all the potential that is there. Obviously, this is a journey. We're getting in, we are getting distribution, we are activating the marketing campaigns. We are putting campaigns in place which will drive the consumers to the stores. So obviously, it's going to ramp up over time. But we are very confident based on the research we have done and the initial response we have received that we should be able to have a strong performance going forward. Obviously, this is not a one-time activity. This is the first set of products we have brought to market. There is wave 2, wave 3, all which is going to build our market share going forward. Yeah.
Got it. And in terms of the priority, so we have a target in the top 3 player in these segments. So just to understand, how do you look at in terms of achieving the market share target versus profitability? Will you prefer to have a slightly stronger push in market share at probably a slightly below average margins, or do you think margin focus will also be very high when you chase this growth?
The focus is on making sure that the gross margins are at target level. Obviously, as we are launching this, we will continue to invest below gross margin, but we will not, if you will, sacrifice gross margin, because that needs to be at the target level. The investments in marketing, the investments in distribution will be as what is required. Once we get to a going level and we hit our objective of becoming number 3, then we will begin focusing on getting the EBITDA margins also to target levels, but not in this investment phase.
The way we have launched our products, they're priced competitively with respect to the leaders. Competitively doesn't mean it is lower, but it is priced, in most cases on par. But remember that these are products which are having superior features versus the biggest competitors. So I think they're well priced, and even at those prices, margins are at target level. So we see no reason to price them, any lower. And we would rather invest the margins that we are making to actually drive, consumer traffic into our stores and so on and so forth. Yeah.
Got it. The last question on this market share in fans and air coolers and geysers, if you can.
Please limit your question to 1 per participant. If time permits, you may join the queue for any follow-up. Take the next question from the line of Keyur from ICICI Prudential Life Insurance. Please go ahead.
Thanks for the opportunity. So question is on the growth for each of the categories. I think in the presentation also you have highlighted that there is some slowdown in that at the end of June, and similar commentary has been heard from many of the consumer-facing companies. So any outlook on how the demand is shaping up for each of the segments like ECD or Butterfly, kitchen appliances? So if you can throw some light on say outlook or how the exit run rates were.
See, one, as you look at the impact towards the back end of June, it's obviously important to remember that in the base period, June had begun to come back to normal. In the base period, it was really April and May, which was for us at least and the industry severely impacted. So obviously on a straight index versus a year ago, there is a big difference as you come into June. The only other way to look at it is if you look at now a 3-year CAGR, because you have to go back 3 years to get a pre-COVID base. And if you look at a 3-year CAGR, on a consolidated basis, we are showing about a 10 to 11% growth, and on a standalone basis, about a 7 to 8% growth across it. So there is some impact which we are seeing in terms of demand slowdown as we move into this back, but it's a little difficult to read because of these base period impacts, etc. Suffice to say, inflation is having an impact, I think, especially on volumes. And as I've mentioned before, this inflation has had an impact on volumes almost through the last 3 to 4 quarters at least. Now, hopefully, as this inflation begins to settle down and commodity costs, hopefully, if they begin to ease, we fully intend to pass on some of those benefits back to the consumer to keep the volume demand coming back. But we have not yet seen, if you will, a sharp uptick in volume demand once I ignore this base period. Personally, I think that, that's still a couple of quarters away because it takes some time for it to come back. So it's not getting worse. If anything, it's getting slightly better trend-wise, but is it the kind of volume growth which we have traditionally had? Not yet.
Thank you. You request to join the queue for any follow-ups. The next question is from the line of Sujit Jain from ASK. Please go ahead.
Hope I'm audible.
Yes.
Yes.
One quick question on how do you integrate Butterfly Gandhimathi? So where is the two brands overlap currently? Would the two companies be completely integrated in sourcing distribution channel? How will the related party transactions play out? And how will you use manufacturing facilities of Butterfly to actually produce some of the Crompton lines as well?
Okay. As we've gone into Butterfly and as we've taken control, if you will, of Butterfly, we've been very clear in the phases of our approach. You see, Butterfly was not a business in trouble. But Butterfly was actually proceeding quite healthily. So our first objective in the first quarter has really been to ensure that we understand the business and we maintain the continuity of the business growth and the organization development. Based on the results of the first quarter, we do believe we've been pretty successful with that. Now, as we're moving forward over the next few quarters, we're beginning to work the details of where are all the possible synergies which address some of the areas which you mentioned. Once we are clear on that plan in detail, and we expect to do that over this coming quarter, we will then identify what is the right, if you will, legal structure to support and enable this plan. We and the boards of the two companies have not yet taken any decision on that matter. In the meantime, obviously, they are two independent public listed companies. So with two independent boards. So we continue to work certain related party transactions as per required on a arm's length basis, as and when needed. So everything is, which you mentioned, is possible, and everything is under consideration. The good thing right now is actually there is not too much direct overlap. The only area actually from a product segment wise where there is overlap between the current Butterfly business and the current Crompton business is mixers. And in mixers, our Crompton business is actually quite small. All the other areas of gas stoves, pressure cookers, other kitchen appliances, there is no overlap. So we are not seeing any big risks or issues with overlap. We are continuing to identify clear opportunities. We've identified opportunities in purchase synergies. We've identified opportunities as we've moved on in various cost reductions. So we've initiated a program called just like the Crompton Unnati program, where we have already identified a reasonable amount of potential cost savings in Butterfly, all of which will lead to helping us A, improve margin, B, even more importantly, generate funds for investing behind further expansion and growth.
Thank you. The next question is from the line of Amit Binde from Morgan Stanley. Please go ahead.
Hello, can you hear me?
Yeah, sure.
Yeah. Sir, I wanted to understand when you say that you want to be in the top 3 in the new category, what would be the market share number that you would like to give, or in other ways, if you can tell us as to how much would be the share of revenue that this new category would make in the next 3 years? That is question 1. And on the lighting part, when you said in Q1 that there's a recovery in the B2B and B2G segment, so if you have to compare this with the pre-COVID level, can you just give us a broad idea as to how much was the portion of lighting revenue that was coming from this segment in pre-COVID period, and what would be the outlook, like 2 quarters, 3 quarters, 4 quarters? What is the visibility that we have for a recovery to that extent in the segment?
Yeah, if I look at for the kitchen appliances, the built-in kitchen appliances, I think top 3 would mean that market share of at least 10%. Shantanu mentioned this business is 2,200 crores as a market size, growing 10%. So you can imagine a 10% share on that will get us to the top 3 in 2 to 3 years, in 3 years from now. That's one. I think, yeah, in terms of the lighting question, definitely I would say on B2B, especially the trade, which is non-government, I would say the demand is more or less back to the level which we had pre-COVID. But on the government side, because the ESL business was such a large part of the total B2B government business, and that has completely vanished. So B2B as a whole, I would think we'll come back to pre-COVID levels if everything stays okay, maybe in another couple of quarters. But B2C has been strong, even compared to pre-COVID period. If I look at B2C LED alone, I mean, there has been a volume growth. And that's why I said most of the growth we have had also has been primarily volume-led. So, yeah. But of course, going forward, one needs to factor in the fact that there's a GST increase and so on and so forth. How that plays out, we'll have to wait and watch.
Thank you. The next question is from the line of Chinmay Gandre from Reliance Nippon Life Insurance. Please go ahead.
Yeah, my question has been answered. Thank you.
Thank you. The next question is from the line of Akshan from Fidelity. Please go ahead.
Hi, sir. 2 questions. On air coolers, could you just help us understand what's the scale of the business today? And you mentioned growth, but last 2 years the base has been really low, so hard to understand how you scale that business. And on the built-in kitchen business, could you just repeat what's the kind of gross margin targets that you are working with on that business? Thanks.
Yeah. So air cooler, if I look at the 3-year period, okay, let's forget the last 2 seasons, which has been impacted by COVID. We have had a 45% 3-year CAGR. Okay. So the CAGR for air coolers versus the last normal season we had, just 3 years ago, was 45%. So I would think the air cooler numbers, while looking 200% over last year, is still a strong 45% CAGR over 3 years ago. So it's been that's pretty solid. In terms of the kitchen built-in appliances, Shantanu mentioned, the gross margins will be on par with our best categories. So that is also pretty strong.
Sorry, Matthew, just a quick follow-up.
This season we had nearly close to 100 crores of business. So 45% CAGR over 3 years ago.
Okay, perfect. Thank you. Thank you so much.
Thank you. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hi. Just 2 clarifications. One was on Butterfly. You've talked about adding new channel partners. Just wanted to ask or check whether it's all incremental or are we seeing a churn or replacement of existing dealers? Any more color on what is the quantum of number of outlets where these products reach today? And if you could also share the salience of online channel in the quarter for revenue. And the second was a small clarification on the built-in kitchen side. You talked about EBOs. Any color you want to share on the target number of EBOs you want to have over the next 3 years? And are these all franchisee-led or are these company-operated? Thank you.
Yeah. In terms of Butterfly, I think a lot of the growth in the previous year, or maybe 18 months, has come from e-commerce. I think Butterfly is over-indexed actually on e-commerce versus the industry average. So our position there is to keep our business on e-com while we aggressively scale up the retail business, which is which is an area which has not grown so well in the past. If I look at Q1, we have added almost 1,000 new outlets in terms of retailers and about 100 direct channel partners in Butterfly. So we don't see any significant churn. In fact, like I mentioned, we are trying to have a much better combination of sales growth coming from e-com versus general trade. So we actually think that the chances of any significant in the general trade distribution is quite low. And the numbers you see in Q1, 100 direct channel partners, 1,000 retailers coming in, I think is been pretty strong. So I don't see any issue there at all. Yeah. In terms of your question on kitchen appliances, I think EBOs are going to be pretty big in the top 10 cities. Our target in the short term is roughly to have about 40 to 50 EBOs in the next 3 months or so. And then in the next run of towns, I think we have to see what kind of format these EBOs are going to take, if they're going to be there. And all the EBOs we are putting together are all franchise operated, nothing that is company done. But we are working in a way that they are self-sustainable, in the short term. So we are focusing our effort to make sure that they can survive on their own without need of company support. And we are very confident the way we have configured the economics, that will happen in a very short period of time. And we have also, looked specifically for partners who have that mindset that doesn't have to be from day zero. So they are also willing to invest. And especially after they have seen the offering that we have on the table, we have a lot of people asking us for investing in EBOs. And we're very confident that this will work well going forward.
Thank you. The next question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity. Couple of questions from my side. The sharp increase in the employee cost, could you help us understand the reason behind it, and if you could just break between what's the incremental to the KMP versus the others? If you could just help us understand the reason why the CFO left and why he sold shares just before his resignation announcement came. These are my 2 questions.
Okay. Yeah. First, in terms of the employee cost, as I mentioned earlier, the employee cost has two elements to it, which just sort of help put it in perspective. One is that there was the variable pay factor, which is decided by our board, especially the factor related to our performance versus competition, which accounts for 50% weightage in the variable pay across the company on the company factor. That gets declared and decided after the year end because it is done by the board once we have published results of competition. There was a certain amount of under provision on that, i.e. basically the board judged our performance to be better than what we had judged it ourselves. The second factor is that in the base period, we had given, due to COVID, we had given our annual increments in July. This year, obviously, we went back to our normal cycle and gave them in April. So if you want to look at what is kind of a run rate for coming quarters, probably somewhere between 100 and 105 crores would be the right run rate to take. That is the first question. Second, none of this was due to any incremental weighting, I will assure you, to KMP. Our typical process is that invariably, myself, for example, the board typically gives and approves an increment which is a few points below the company average increment. So we never weight this towards KMP, I can assure you. It is because it is the employees who do deserve the reward for their performance. Your last question, I can give you Sandeep's telephone number and you can speak to him and ask him what he did, why for, right? Because he's the right person to speak to about that. Obviously, he has gone back to his home company, if you will, right? But beyond that, there's really nothing for me to comment on, but I'm happy to give you Sandeep's contact.
The only other thing you mentioned on is ESOP. Your share sale, obviously the shares lapse if the person leaves the company. So it was natural that he exercised his options, no? It's natural only, nothing beyond that. Yeah.
Thank you. The next question is from the line of Gaurav Birmiwal from Credit Suisse. Please go ahead.
Yeah, hello sir. Thank you for the opportunity. So can you detail what kind of capex and working capital you see in your kitchenware portfolio?
Okay. In the kitchen portfolio, you said?
Yes.
See, I mean, because most of the investments, as you mentioned in this, in all these stores, are primarily only franchise operated. So we don't see any significant capex that we will have to bring to play because they're all done by franchisees. At the moment, our business is on 100% sourced from outside. So at the moment, no capex even on the back end, at least in the foreseeable future.
So at some point in the future, when this business reaches a growing stage, obviously at that point, we will look at beginning to localize and make ourselves the ones or the items which make sense to work ourselves. But right now, in this period, it is completely sourced. So there's no significant capital involvement.
Thank you. We take the next question from the line of Aditya Aluwale from Invesco. Please go ahead.
Yeah, hi. Thanks for the opportunity.
Aditya, may I request you to please come a little more closer to the mic?
Yeah, I'm sorry about this. I'll just try to speak louder. Just one small question. So assuming no pricing actions and the current commodity prices, are the margins back to 4Q level or FY20 average levels already? Assuming no price decline or nothing.
As I had mentioned, and I think as Matthew mentioned, our exit margins this quarter were pretty much in line with going margins. So obviously the margin has improved from March to April, April to May, and May to June. So exit is in line with going margin levels.
Okay, and if I can squeeze in one more, you said the fans volume CAGR has been 5% over the past 3 years?
Yes, that is correct.
And do you think it is fair to assume a similar trajectory going forward, given the penetration and given that you are already a very high market share?
No, I think it's again a function of a combination of volume and value, because if you go back pre-COVID, most of the growth was volume-led, right? So as right now there's a combination, over this period there's been a combination, growth has been a combination of volume and value. So as we look forward, as inflation, etc., all eases off and the macro situations normalize, we once again expect, like has traditionally been the case in fans, that all the growth will be volume-led. So we definitely expect a couple of points uptick in volume growth over time moving forward.
Thank you. Ladies and gentlemen, due to time constraints, that would be our last question for today. I now hand the conference over to Mr. Renu Baid for closing comments. Thank you, and over to you, ma'am.
Thank you, Aman. On behalf of IIFL Securities, I would like to thank the participants in the management for an interactive call. I will also now request Shantanu for any closing comments before we close this call. Thank you, and over to you, sir.
Thank you, Renu. Thank you, everyone. As always, appreciate the fact that you took the time to join the call. Our objective is always to try and give you as much information, clarity as we can. As always, if due to time we've not been able to cover all the questions, please contact us. We're more than happy to spend as much time as you would like discussing our business. Thank you so much.
Thank you very much.
Thank you.
Thank you, ladies and gentlemen. On behalf of IIFL Securities Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.